AngloGold Ashanti is the world's third largest gold producer. We've got 19 operations in 9 countries, including Australia, where Sunrise Dam and Tropicana contribute 14% from Western Australia to the AngloGold Ashanti production, total of about 4 million ounces per annum. Something that does differentiate us somewhat from the other majors is the fact that 2/3 of our production comes from countries where we have currency leverage, which is particularly relevant in today's market. It's good to have the opportunity to talk about gold today because in Australia in particular, gold is one of the brighter lights in a somewhat gloomy resources sector. Gold mining is also very important to the West Australian economy, as this chart shows, generating an estimated $9 billion in export earnings in 2014-15. It's also Australia's 4th largest commodity export earner by value, behind iron ore, coal and natural gas. Today I'd like to briefly touch on some of the key factors that are influencing the gold price, as well as the gold equities themselves, and how companies such as AngloGold Ashanti are adapting to the challenges of the current operating environment. So in US dollar terms, the gold price has declined from a peak of almost $1,900 an ounce in September 2011 to a low of just under $1,100 an ounce in August of this year, which is quite a dramatic change. There's no doubt that we're now in a very different phase in the gold market, one that's likely to stay with us at least for the medium term, as I'll go on to explain. The drivers of the gold price are diverse and complex, incorporating the fundamentals of supply and demand, global economic conditions, central bank policy, and of course, sentiment. This makes forecasting particularly difficult. However, analysts are fairly united in their view that the outlook in the short to medium term is subdued, like many of the other commodities we're hearing about today. Consensus for the price is around $1,150 an ounce next year, and is likely to be range-bound for the foreseeable future, averaging in the order of $1,200 an ounce. So what's brought about the decline in the gold price, and what are likely to be the key drivers going forward? Well, gold has traditionally played a number of roles. For centuries, it's been part of the monetary system, a store of wealth and a safe haven investment in times of economic uncertainty, and we mustn't ignore its use for adornment. The World Gold Council estimate that 49% of all gold mined has been used for jewellery. All of these factors are influencing the price today. The single most important factor putting economic pressure on the gold price in recent years has been economic recovery in the US and the subsequent strengthening of the US dollar. The quantitative easing that the US Fed introduced as part of a bid to support the US economy post the global financial crisis has tapered off, and US economic indicators are generally more positive. The strength of the US dollar has seen it take over the superior return and safe haven characteristics that once belonged to gold. The impact of US economic conditions on the gold price were very apparent earlier this month when the price rallied in response to weaker economic indicators out of the US and speculation that the US Fed would not lift interest rates in 2015 as previously expected. The key factors that will influence the price going forward are of course, a US Fed rate hike. US economic conditions, if they improve, will be negative for gold as well. Investor demand. There have been outflows from the gold ETFs, and while retail investment demand in China is held up, it tends to respond to price weakness, so will only pick up if the price falls. Jewellery demand. In China, jewellery demand is stabilising, and in India, which is the largest market for gold jewellery, demand for refined gold has been soft in response to regulatory restrictions by the government on the import of gold. Interestingly, recent intelligence suggests that this weakness in India is now is because India is now importing an increasing amount of unrefined doré bars, typically the bars that you would produce at the mine site, which is a gold-silver alloy of about 80% gold, due to its tax benefits. So official data may not represent the full picture. Central bank, global economic conditions, which remain uncertain and provide a floor to the price, and central bank activity. So its delegates heard at last week's London Bullion Market Association conference, which is the largest industry conference for precious metals. Central banks continue to see gold as an essential asset. Overall, central banks are expected to remain net buyers of gold, with buying expected to increase in regions such as Russia, China and the Middle East, and developed countries maintaining their holdings. This all adds up to an outlook for gold that is subdued, but not overly bearish. Despite the subdued outlook for the price, there's been a mood change in gold equity markets just recently, just in the last couple of months. There was a more positive feel reported at last month's Denver Gold Forum. Gold equities, which were just abandoned by investors when the price fell sharply in 2013, are now seeing some support as funds return slowly to the sector. Over the past 3 years, the lower gold prices have forced producers such as AngloGold Ashanti not just to cut costs, but to improve efficiency and productivity, find innovative ways to work smarter to preserve margins. This slow but steady improvement in the cash generation capacity of the miners is going a long way to repairing the balance sheets, improving investor confidence and enabling companies to reinvest in the business. There's been quite a bit of talk today about currency devaluation and the hard work that the mining companies are doing to lure investors back to gold is the critical factor in that now is the strong currency tailwind that a number of producing countries are feeling. So weaker currencies in key gold-producing countries, where costs are predominantly in the local currency, has had the impact of significantly increasing margins and offsetting the fall in the gold price. Nowhere is this more apparent than in Australia, where the Aussie dollar spot price has risen by almost 25% in the past year to more than $1,500 an ounce. Today the price is over $1,600. It was $1,640 this morning when I looked. And Macquarie Bank research is forecasting an average Aussie dollar gold price of around $1,670 in the 2016 financial year. So this, along with operational improvements, has enabled Australian producers to generate strong free cash flow and accelerate repayments of debt. It has also seen the Australian gold sector outperform, with the ASX All Ordinary Use Gold Index rising by almost 50% this year. And most of those gains have actually come since August. Now, AngloGold Ashanti is in fact a good example of the importance of currency on an unhedged global producer, with the depreciation in the South African rand, the Brazilian real and the Australian dollar, all contributing to an improved spot price for our production out of these countries. The impact of this diverse currency exposure can be seen in this chart, which shows the price we received for our gold increased by 2%, as the US dollar spot gold price actually fell by 8% over the same period. The factors that put pressure on the gold price tend to also cause currency weakness, providing a natural shield. But as an industry, we can't rely on currency alone to thrive in what looks like a lower for longer gold price environment. It's vital that miners make sustainable changes to their cost structures. And by this, I don't just mean by simply cutting costs. Instead, we have to address productivity issues and introduce innovation to lift performance and be resilient in the face of potentially longer-term weak gold prices. In the past 2 years, AngloGold Ashanti improved costs in absolute and relative terms, led by its international operations, which we have separated out on this chart from our South African mines. The international operations comprise 75% of AngloGold's production, and in Q2 this year, the group reported all-in sustaining costs of $844 an ounce, which is absolutely world-class. Now, this has come through enhanced efficiencies from supply chain, talking to contractors, suppliers, right through to our mine plans. We've also cut corporate costs dramatically to 2/3 of the industry average. Now, an example of the innovative thinking we're applying to finding new ways to improve margins is the study we are undertaking into an alternative mining method at our Tropicana mine here in Western Australia, which we manage with a 70% interest. Our joint venture partner, who has 30%, is Independence Group. The study is looking at the application of mine design techniques that are more commonly used in mining other commodities, such as coal. The approach, which involves strip mining of a large cutback to expand the pit, would reduce waste stripping costs substantially with input pit waste dumping and shorter haul distances. This is not at all traditional Western Australian open cut gold mining methodologies. The exploration work associated with this study has been greatly enhanced by a 3D seismic survey, the first on this scale in hard rock mining in Australia, which has been used to generate a detailed structural model of the deposit to help cost-effectively target the resource drilling program. So investors are starting to look at gold equities again, but they are focusing on quality more than ever. They want to see credible management, stronger balance sheets, prudent risk management, and a strategy that is focused on shareholder returns. Companies like AngloGold Ashanti are responding to this. In our case, this has included proactive actions to deliver on our commitments. Since 2012, production and costs have been in line with or better than market guidance every quarter. Reduced debt to strengthen our balance sheet, in this case through the sale of an asset, and improve our portfolio to focus on long-life pure gold assets. So just in conclusion, as an industry, we mustn't be lulled into a false sense of security by the benefits we're currently deriving from currency weakness. It's vital that we continue a relentless focus on productivity and efficiency that goes well beyond merely stripping out costs, so that mines can generate sustainable margins. If we can generate strong free cash flow, we'll be able to invest in exploration. When commodity prices fall, exploration is one of the first areas to be cut back, yet exploration represents our future, and that applies to all commodities. We're fortunate in WA to have the support of the state government's exploration incentive scheme, which has co-funded many exploration drilling programs, as well as funding geophysical and geochemical surveys in key regions of the state. We're also fortunate in the state to have a highly skilled mining workforce, world-class service providers and knowledgeable regulators who understand our industry. Australia is the world's second largest gold producer behind China, accounting for 9.4% of global production in 2014, and delivering export earnings of $14 billion in 14-15. The health of our gold industry is not just something that benefits our own employees and shareholders, but the economic welfare of this state and the country. Thank you.